Good morning, everybody. My name is Don Daniel, founder of Pill Method International, a better way to eliminate debt. And today we're going to be talking about mortgage interest, 139.5%. Can you imagine that? That may seem like a number that is way out of whack, but it's not. I'm going to show you today not only the real interest rates behind mortgages, we're going to find out why they are the way they are, why we pay so much in interest on these mortgages, why it's set up this way, and why the interest the interest rate you're quoted is not the interest rate you pay. So, if you're ready to hear the truth this morning, listen, buckle up. Let's get ready to go. Let's get started right now. All right, my name is Don Daniel, founder of Pill Method International, a better way to eliminate debt. And today, folks, we're getting deep into this thing. There is a reason why mortgages and other loans are the way they are. We don't know the truth about what's really happening behind these loans. Let me tell you something. When I did the research on central banks around the world, what I found out is that their main asset, their main way of making money is interest on loans. And the way that they can continue to make that kind of interest on loans is that we remain ignorant of how they actually work. We're not supposed to know what is happening behind the scenes. We're not supposed to ever know because it's not taught in school. I'm going to show you some things today on mortgage interest and how other loans work, just so that the working people of the world become the gold mine, the gold mine of the rich. Oh, listen, I want to hear from everybody who is listening today. Where are you listening from? Put it in the chat, put it in the comment section, and ask your questions today. And if you want to come into our show, the link is right there in the comment section on YouTube. So come on in, click on that link, put it in your Chrome browser, and come on in and ask your questions live today. It is going to be a tremendous show. Let me go ahead. I'm going to move some screens around here today. So let me move this around. And we're going to put this on the screen today. I need you to see this. This is a $500,000 loan. Okay, there it is. So let me change this around right quick so we can actually see it better. Okay, there we go. And there. Okay. All right. So this is a $500,000 loan at 3% for 30 years. And if you're in Clubhouse and you want to see this, go to YouTube so you can see how the bank gets away with charging us 139.5% on loans. We're going to get there, but we're going to start out with this one first. It is five. Hey, Ken, come on up. All right. I invited you, Ken. Let's see. There he is. All right. Ken, how are you doing this morning, sir?
I'm all right, Don, getting the kids off to school.
Okay, man. Listen, I'm glad you're here because today we're going to reveal the truth behind why these loans are the way they are and why we don't know what we're supposed to know about them. Okay? So I need anybody who wants to know to ask questions come up to the stage here in Clubhouse, or if you're watching us online, come ask your questions online on YouTube. And when you join YouTube, make sure you subscribe to our YouTube channel and hit that notification bell because every time we're on, you need to see this. So, first of all, folks, we're starting out with a $500,000 loan. It's a mortgage, and the payment is $2,108.02. Now, the payment is not outrageous. In fact, the payment here actually is for the same size house. The payment is probably cheaper than rent. Okay. But this is a 3% mortgage. This is a 3% mortgage. And I want to show you what's happening behind the 3% mortgage because the interest rate you're quoted is not the interest rate you pay. So let's take a look at this thing. Okay. Uh-oh. I changed screens. Uh-oh. Let's go back. Let's go back. I need you to see this. All right. Let's pull this back up. Okay. So a $500,000 mortgage at 3%. The total interest paid on this loan is $258,887.20. $258,000, folks, at 3%. That really means that the total interest paid as a percentage of principal is 51.777%. So on a $258,000 house, the bank wants you to pay, on a $500,000 home, the bank wants you to pay $258,000 in interest. Does anybody here believe that at 3%, $258,000 in interest is way too much to pay on a $500,000 home at 3%? Okay, so let me then show you what if it's $500,000 at 4%. Okay, so let me put this slide up at 4%. At 4%, here's what it is: $359,384. That's 71% of what you borrow. So 4% mortgage, if you're not careful, actually becomes 71%. Ken, what do you think about that?
Strong armed robbery.
Come on, man. 4%? We're thinking 4% when it's really 71.870%. What if it's 5%? Now we're paying $466,279. That's almost as much as we borrowed in principal. Why is it that we don't know what's going on? Because there are a lot more workers in the world than there are the super rich. So what do the super rich do? They figure out how they can make money from mining resources, whether it's gold, whether it's silver. And right now, what's in the news is rare earth minerals. That's in the news right now. But folks, did you realize that the new gold is mortgage interest or loan interest mined from the workers of the world, no matter what country they're in, because we don't know how the loans work? Can you imagine if just think about just in the country you're in, no matter what country you're listening to me from. Well, just imagine everybody in your country who has a mortgage. We're not even talking about credit cards, just the mortgage. And you have a 4 or 5% loan, and 71% of what you borrowed turns into interest to make somebody else rich. Now, the way it's done, the payment you have to make is not outrageous. The payment you make is well within reason. But there's something that's done to the payment that takes money out of your pocket, your ability to gain wealth, and transfers it over to someone else. And if it's 5%, now we're talking about making 93% off your mortgage going to somebody else. What if it's 6%, ladies and gentlemen? Now we're paying $579,190. At on a $500,000 loan, that's a total of $1 million paid back. I'm going to show you all this broken down in how you would be looking at it if you were signing this mortgage today. Now, we're taught to look at one place where the people who are mining your blood, sweat, and tears, you're trading hours, your work hours for dollars so that you can turn around and have your dollars discounted when you buy a house, when you buy a car, when you buy education. It gets discounted at that time, and 80% of the money you pay towards a mortgage turns into interest for somebody else to use and to invest. They get rich while you get a house. Oh my goodness. And you don't even realize that it's happening. Now that's at 6%. What if it's 7%? Because mortgage rates are close to 7% right now. A $500,000 loan at 7%, Ken. And who else do we have in here? Okay. Shoshana. All right. How you doing, Shoshana? At 7%, it becomes 139.5%. You're going to pay back $697,543.60 on this mortgage. On a $500,000 mortgage for 30 years, you're going to pay back more in interest than you borrowed in principal. That means 139.5%. 139.5%. Let me take this off the screen, okay? And we're going to break this down, okay? Another way. I'm going to move this over here, okay? So you could see me better, so I could see you better. All right. Here is how this thing breaks down. $500,000 at 3%. The payment is $2,108.02. We love the payment. But when we take a look at the summary, when you are sitting in the office closing on this loan, all of this is revealed to you. It may not be explained, but it is revealed to you. You know what the payment is. You know what the total interest is going to be. But for some reason, if it's at 3%, the $258,870 in interest that the bank wants from you, it doesn't register that's 3%. That 3%, it really is 51%, even though the papers that you're looking at, even though the papers you're signing, it says total interest paid as a percentage of principal, 51.777%. Even it's right there in front of us. But we're so happy to get the house. We don't realize that we're setting ourselves up to have somebody siphon off our wealth. And this is just at 3%, ladies and gentlemen. What if, let's break this down on a 4% mortgage. Okay. At 4%, the payment is still decent. It's $23.87, $2,387.08. But what we don't see is that on a 4% mortgage, the bank wants $359,348.80, which means that total interest paid as a percentage of principal right here, 71.87%. How did we get here? So that we don't realize that our 4% mortgage is really a 71% mortgage. How did we get here? And on a $500,000 home, we're going to end up paying, watch this, $859,348 if we're not careful. Who wants to pay $859,000 for a $500,000 home? We do it so slowly. We do it imperceptibly. We do it so that we don't notice how much interest we're actually paying. Somebody's getting rich, ladies and gentlemen. It's not us. I want to tell you that the amount of interest that the bank wants on this mortgage is just a suggestion. You don't have to pay it. Hopefully, we can get there. Hopefully, you can find out how you don't have to pay it. But let's take a look now at a 5% mortgage, how that breaks down. Look at this. $500,000, 5%. The payment is $26.84.11. Now, we get focused on the payment. We can make the payment. The payment is good. The payment is okay. $26.84.11. It is still good. But the way it breaks down, your payment is getting chopped up so that only a small amount of your payment goes to pay down the loan, and a huge amount of your payment gets discounted and called interest and goes to somebody else so that they can build wealth with your money. You go to work. You take time away from your family. You're providing a home for your family, a backyard, a nice street to live on, sidewalks to walk on in the evening. Your lawn looks great. I mean, everything about your life is fine. You're driving a nice car. Everything looks good, except you're not realizing what your interest consumption is on a monthly basis. The average family pays 35 to 39% of their income just on interest alone. And it's making somebody else rich, and it ain't us. Watch this. So on a $500,000 loan at 5%, the bank wants $466,279. What? That's almost as much as you borrowed. By the time this house is paid off, the true cost of your dream home is $966,279.60. Folks, that's nearly $1 million you're paying for a $500,000 home. How did we get here? And we're not even at 5% interest rates right now. Let me show you a 6% rate. Here it is, a 6% rate. Let me get rid of these advertisements here. Okay. Here's the 6% rate. Payment $2,997.75. Uh-oh. Look how much interest they want. On a $500,000 loan, the bank wants $579,000. Hey, Matt, come on up to the stage. Good morning, Matt. How are you?
Good. Good morning, guys. How are you?
Good. So, are you, what do you have to contribute to this conversation today about mortgages? actually being 139.5%. And we're going to break that down for you.
My mortgage is approximately at 2 point I think it's 5%.
Okay. So let's stop here. And I'm going to put up a brand new example. Now I'm showing this on YouTube. So if you want to see the numbers, go to your computer or your tablet, pull it up. Okay.
Okay.
All right. So
Yep.
and go to P.I.L.L method and we'll show you the numbers.
Okay.
All right. So duplicate the tab. Now tell me approximately how much was the original amount of your mortgage, Matt?
Approximately 500,000.
Oh, look at here. We're doing a $500,000 loan today. And your interest rate is what? 2
2.5.
Okay. So you have a pre-pandemic loan.
I have basically pre-pandemic loan. Yes.
Yeah. Okay.
People were starting to get the sniffles.
Listen.
I have a sniffle loan.
Okay. Let me tell you something. Now, what's going on with these loans? Okay. Now, everybody is trying to get the lowest interest rate they can, and they're not trying to move, even though moving might be of a benefit. They don't want to give up this 2.5% loan. Okay. So let me show you what's going on with this loan, Matt. We're going to take this payment out at 2.5% on a $500,000 loan. The principal and interest on this loan is 1,975. I'm sorry. Do I have too many numbers in here? I do. Sorry. All right, let me do this again. There it is. Okay. 1,975.60. That's the principal and interest payment. We're not talking about the taxes and insurance. Okay. And the amount of interest that the bank wants on a $500,000 loan over 30 years is $211,216. Matt, does that sound like 2.5% to you?
I'm sorry. Can you just repeat that real quick?
Okay, sure.
Thank
On a
you.
$500,000 loan
Correct.
at 2.5%,
Correct.
the total interest paid over 30 years is $211,216.
That seems short, I think.
Okay.
Maybe.
Well, it all depends on. We're what on your loan. We're just putting in approximate numbers.
Yeah.
Okay. So if you gave me exact numbers, this would show up exactly what it is on your loan papers. Okay.
So let's see. I did 500.
Mhm.
So actually it was 600 because the loan I put 100 down.
Mm-hmm.
So 600.
So you borrowed 600.
No, sorry. No, the mortgage was 500.
So you borrowed 500. Okay. So
Yeah,
we're only talking about what you borrowed is 500.
Sure.
Okay.
So the loan amount. One sec here.
Okay.
Let's grab my numbers.
All right. Now
So
I tell you what you can do. If you're looking at your statement,
yep, that's what I'm pulling up right now.
give me the principal and interest payment added together. Okay, Abby, we'll bring you up.
Okay, one sec.
And once you get that, we'll put the numbers in so you can see this, and we'll use yours as an example here of what's really going on with these mortgage interest rates. Then the interest.
Yeah, my total interest is around 200,000.
No, I need on your for every payment, give me the principal and interest payment added together for just one payment.
Let me see if I can grab that on my app real quick.
Okay. Because on $200,000, yeah, this is what we're coming up with.
About 200,000 in total.
Yeah. So we're coming up with $211,216 on a $500,000 loan at 2.5%. So Matt,
Wait, repeat that very last part again.
Okay.
As I was looking at my app.
All right. 211,216.
211,000. Yeah, that's about the amount of interest I pay.
Okay. So here's my question.
Yes, sir.
Is 211,000 2.5% of 500,000?
No, but
No,
that's not how mortgages work.
I know.
So,
But
but that's the interest rate
yeah,
in the mortgage calculation. So
that's
no one's saying that that number is a multiplier of the principal.
so. Can I ask you what you do for a living?
Someone's just saying,
Can I, can I ask you what you do for a living?
yeah, I work in financial consulting.
Okay, you're working in financial. Most people do not.
Right.
So when they're looking at this, they're thinking they're loving the fact that it's 2.5%, and they never pay attention to this.
Well, of course they do. They know that 2.5% is not the multiplier in interest they're paying. It's the interest rate,
Mhm.
right? In a term sheet, basically in a grid,
Right?
right? That ultimately uh is it's basically like a schedule grid,
Mhm.
right? And it's a combination of this 2.55 or whatever the interest rate is,
Mhm.
and the principal, right? The proportions change
Okay.
as you pay off that mortgage.
Well, let's ask this question, Matt.
Yeah.
Do most people really think about the fact that when they buy this $500,000 house at 2.5%, that they need to pay $211,000 in interest in total?
Yes, because that's what allows them to actually purchase the house.
No,
Because
that Matt,
most people don't
Matt,
have
Matt,
$500,000.
I just asking a simple question here because I'm the one teaching, not you.
Oh, I'm sorry. I'm sorry. Yeah, you're right. You're right. You're right. Yes, most people that have a mortgage
Yeah,
understand the total interest that will be paid over the lifetime of that loan, whether it's
okay,
10, 15, 30 years.
right. All right. So I see Amari Parks says watching us on YouTube this morning. But here's what's happening, folks. When you
So
break,
I think real quick, I just want to say, like,
sure.
the 200 that I'm paying in
Hmm.
interest,
Yeah.
that's the cost. That's essentially the cost of doing business. That's essentially the cost that allows me to live in my $600,000 home,
Hmm.
500 of which I'm taking a loan out for.
Uh-huh.
But that's the cost of doing business that allows me to pay monthly payments within my budget
Yeah.
to live in my residence, because I, like most people, can't afford using cash on hand in our checking and savings account
Hmm.
to purchase the piece of property outright, knowing that it would only cost $600,000. I'm paying close to, what was it, 800 and change, right, at the end of
Right.
the day. So when you look at it, yes, I have to think that my house is not 600,000, right? It's really 800, and
Hmm.
I could either buy it, right? There's really just two options. Option A is I could buy this house for 600 in cash,
Hmm.
right? Or I could buy it for 812,
Hmm.
with and
That's
I could
option
do
B.
that by paying 30, for 30 years, paying whatever it is,
Hmm.
25, $3,000 a month.
Yep. That's
And if that's within my budget,
yeah.
then that's the cost of, quote unquote, doing business,
I
right?
got you. I got you. That's option B, but there's an option C.
Okay. I'm all ears.
You don't have to pay all that interest if you don't want to.
Okay. Teach me.
Okay, let's talk about that. So, first of all, I'm putting a calculator on the screen. On this loan, we're taking the 2.5%, 0.025, okay, and we're dividing that by 12,
Okay.
okay? And so every single month, your unpaid balance is multiplied by 0.002083 and a bunch of threes after that. Okay. So if we take $500,000 and multiply it
What?
by, listen,
I'm sorry. No, no, no.
listen.
That number? No, no. I'm trying to follow along. I'm just trying to follow along. I'm
Okay.
not trying to interrupt. How did you get to that number again?
We take 2.5%
Okay. Okay.
and divide it by 12.
Okay. Okay. Thank you. I'm not trying to when I interrupt, it's just because I'm trying to follow along step by step.
Okay.
I'm not trying to compete.
All right. 2.5%, and then we're dividing by 12. We take that number and multiply it by 500,000. So we're going to multiply it by 500,000. Okay. And it equals $1,041.666. So we have to round that 6 up to a 7. $1,041.67. When we roll down here to our first interest payment on this loan, it is exactly $1,041.67. Okay. So that means out of your payment of $1,975.60, $1,000.41 is discounted from your payment. So only $933 is left to go to principal. So far, so good?
Yeah. One more time on that last part.
Okay.
I'm just taking some notes.
Okay. 1,000 out of your payment of 1,975.60. Your payment is discounted by $1,041.67. And your principal, the amount that's left to pay down the loan, is $933.93. Okay. Now, if you want to see the numbers, go, pull us up on YouTube on your tablet or your because once you see the numbers, it makes sense. Okay. All right. So here's the next thing we need to understand. We're going to take a look at the first interest payment, okay, of $1,041.67. Because somebody's getting rich here, Matt, and it ain't us. All right. So we're going to take that and divide it by your principal and interest payment, your minimum payment. So we're going to divide it by $1,975.60. That's 53%. 53% of your payment is interest. Now, even though you realize that saving up $500,000 is not is out of reach for most people, and borrowing money is the way to go. And I do believe in borrowing money. I love the bank because they have a product I need. It's just that they're charging way too much for it.
But I don't know how to get. I understand what you're saying. I just don't understand how to obtain what you're providing.
What? So how to pay less interest?
Correct.
Okay, well, let me show you. All right, you ready?
Okay. Yep.
All right. So if we take a look at the very first payment, let's call it January. Okay. And we made our mortgage payment, and we take a look at February's principal payment. Uh-oh, he left. Uh-oh, maybe he'll come back. If he comes back, let him back in. Okay. But we started down this road. Okay. So if we make this payment here and we take a look at February's principal payment of $935.88, if we prepay this, we don't have to pay this interest payment. So for everybody who is watching this, we don't have to pay the interest the bank wants us to pay. If we choose to pay the bank back their money on our schedule, we don't have to pay them all of this money. Okay. So let me go back to where I was until he comes back. Let's see if Matt comes back. All right. So where I was on this journey was at a 6% mortgage, The payment is $2,997. But out of that, out of a 6% mortgage on a $500,000 loan, the bank wants $579,000. They want more in interest than we're paying in principal. That is ridiculous. And we don't have to say that. Amari, what is it that you have to say here? Okay. It says, what does she say? She says, you haven't said most people don't pay off their mortgages. You're right. You're right, Amari. So 9 out of 10 people you know, okay, everybody in here listening, 9 out of 10 people you know will never pay off a mortgage. Just count how many people you know that ever had a mortgage and have actually paid one off. We're in a system that is set up so somebody else makes a lot of money. So there's a reason why it's set up this way, but we don't know what that is. What we're doing is, I want to buy a nice house and I have to borrow the money to get it. But what I'm saying here, ladies and gentlemen, is this thing is set up so that investors can reach into your pocket and take monies that are meant for you and your family out of your bank accounts, out of your pockets, out of your blood, sweat, and tears. They take your work ethic, the ability for you to go to a job, make money, bring it home, put it in the bank, and pay your mortgage. They're using that as a way of making a lot of money, even though you get a house, you get a car, you get to pay for your education, you live in a nice neighborhood, and you make enough money so that you can pay your bills and live comfortably. But what we don't realize is the total interest consumption here. How much interest is being consumed monthly that you do not have to pay? So, can we borrow money much cheaper? Yes, we can. So let's take a look at the 7% loan. Now, let's take a look at this first. Total interest paid as a percentage of principal, 115.838%. That's on a 6% loan. You're going to pay 100% interest. Folks, what Matt was saying earlier is that that's the cost of doing business. Ouch. Why would I want to pay 100% interest on a loan? Why would I want to pay back more in interest than I'm borrowing in principal? Can I get somebody else to come to the stage? I need 3 or 4 people to raise their hand, come to the stage. You don't have to say anything. Just sit there. Because you're there, you'll bring more people in. So Ken will help you bring up. So raise your hand. Let's bring you up to the stage. I see you, Yolanda. I see you, Alex. Okay, Steph. I see you, Dea. So come on up. I see you, Bob. Come on up to the stage. And because you're sitting on the stage, more people will come in. All right. So that will be your contribution. You don't even have to do an invitation. Just the fact that you're here will bring people in. So now here is where we got to the 139.5%, the title of our show. Right now, interest rates are right around 7%. Right around 7%. And on a $500,000 loan at 7%, the payment is $697,543.60 over 30 years. $697,000. That makes the interest that the bank wants 139.5%. How many of you looking at this want to continue to pay this kind of money for borrowing your money? There's something going on here that we don't know about. That nobody made us aware of? What is the system that has been put together so that working people not do you realize you're going to pay over your lifetime, you're going to pay way more interest than you'll ever pay in taxes? Do you know how many systems out there? Do you know how many people are teaching you how to save money on your taxes? But nobody. Listen, there are virtually no classes on how to save money on interest when 35 to 39% of your interest payments, 35 to 39% of your income goes to interest payments. That's what we call interest consumption. Now, if you're tired of that, put a number 9 in the chat. If you're tired of paying interest like that, put a number 9 in the chat. And let's go ahead and focus on what's really going on here. We are in a situation where those who have money are renting it to us who don't have money. Now, we call it interest, but what's really going on, it's rent. For as long as you have their money, they will rent it to you at this outrageous interest rate. Now, 7% doesn't look very big in this grand scheme of things. Okay? Because interest rates traditionally have been much higher. I mean, in the 70s, interest rates got to 18%. But when you look at what the interest rate really is, the interest rate you're actually paying here is 139.5% if you are not careful, if you don't learn what we teach here. You don't have to pay that. This amortization schedule, ladies and gentlemen, if you want to see what we have here, click on this link. If you're new to the room, go to or pull up YouTube on your tablet or on your computer. Search for P.I.L.L method, P-I-L-L method, and you can see these numbers. Because the amount of interest that you're paying in the first part of this loan is tremendous. We see 7%. But let me tell you what's really happening with this very first interest payment of $2,916.67. I'm going to put my calculator on the screen. Okay? We're going to put in the very first interest payment of $2,916.67. We're going to divide it by the very first payment. Our payment is $3,326.51 on this mortgage. So we're divided by this. $3,326.51. So that means 88%. 88% of this payment is interest. 88% of this payment is interest. So, in other words, for every dollar you put towards this mortgage, 88 cents of that dollar is discounted. And you're paying your mortgage with only 12 cents out of every dollar. What type of mess is that? Where you're trying to provide a home for your family, and 12 cents out of every dollar is actually paying the mortgage, and the rest gets discounted. And I'm going to share with you where that money goes. When you get your mortgage, generally within a week or two, your mortgage is sold to an investor. And the investor says, you know what? When Bob has to pay his mortgage, when Nancy has to pay her mortgage, all the payment comes to me. All $3,326.51 goes to the investor. The investor liked this idea because out of the $3,326.51 that goes to the investor, only $409 of that money pays down the loan. So what we're trying to do is, once we get a mortgage, think of it this way. Once you get a mortgage, there's a deep hole in your backyard that we are saying that this is a representation of your mortgage, that really deep hole. And you're trying to fill the hole up. But every time you go to fill the hole up, only 12% of the dirt that you're throwing into the hole, only 12% of the dirt actually gets into the hole. 88% of the dirt falls somewhere else. It doesn't fall in the hole. 88% of the dirt you're trying to fill the hole up with goes somewhere else, and it doesn't go in the hole. So that means you have to make another trip to the hole to try to fill it up with 12% of the dirt you have available. Do you know how many trips you have to make? And they set this thing up so that you have to make 360 trips to fill up the hole. But what if you could fill up that hole not with 360 trips? What if you could fill up the hole with only, let's see here. Let's see here. 84 trips. What if you could pay off the mortgage in 84 payments instead of 360 payments? How do we do that? If you want to know, let me see. How many nines did I get before? Okay. Listen. If you pay off your house in 84 payments, that means that's only 84 times they can discount your payment, not 360 times. If you want to know how to pay off that mortgage in 7 years, somewhere between 7 and 9 years, put a number 7 in the chat right now. Put a number 7 in the chat right now. Or if you're online, if you're watching us online, I see there's a bunch of you online right now. Put a number 7 in the chat and we'll go over this. I need you to see the numbers though. If you're not looking at the numbers, it's going to be hard to wrap your mind around it. If you are not in a position to see the numbers right now, please come back to YouTube later on when you can. Subscribe to the channel and watch so that you can understand what's really going on with these mortgages. Somebody's getting rich and it ain't us. The interest rate you're quoted is not the interest rate you pay. There is an inherent weakness in this system. They chose this system because it makes a lot of money. They chose this system because there are a lot more people who need to borrow money to get a mortgage than can pay for a mortgage outright. So if there are way more people that need to borrow money, as an entrepreneur, as a business person, doesn't it just make sense for them to say, how can we lend them money and make a lot of money with it, but make them feel as if they're okay? How can we make them feel as if they're okay, but we still make a lot of money? How do we do that? Okay. We do that by diverting their attention from the interest cost of the loan and have them focus on the interest rate for the loan. Stop focusing on the interest rate and understand interest cost. So the weakness is this. Now, does everybody know what equity is? Everybody knows what equity is. Equity is the difference between how much the house is worth and how much you owe. When you reduce how much you owe and the house either maintains its worth or it actually appreciates. Okay, so if your house appreciates in value, you're gaining equity. If you pay the house down, you're gaining equity. Okay, so gaining equity is something that is desirable for everybody. But the way this thing is set up, every single time you make a payment here, okay, your payment, let me write this down. Let me write this down. What is this total payment? The total payment is $3,326.51. So every time you make a $3,300 payment, okay, only about $400 pays off the loan. So every time you make a payment, you're increasing your equity by $400. Look at that. You start out at 409 on the very first payment, and by the time you've made the 12th payment, you're all the way up to 436. $436 out of $3,326 pays off the loan. So that means you have some additional equity, but you need to see and understand how much getting that equity costs you. You're making a payment of $3,300. They get to discount it by $2,900. That means your equity of $400 cost you nearly $3,000. Do we want to continue to pay money like that for our equity? I need you to really look at this thing. Pull out your mortgage papers later today and look at this and understand what's really going on here. You are a natural resource, just like gold, just like silver, just like copper, just like iron ore that makes steel. You are a natural resource, and somebody has figured out how to turn us all into a natural resource to be mined just like gold and silver, to so that they can use our labor, and the dollars we make, they get to turn it into interest because no one told us how it worked. I just need to know if you're tired of that. Okay? So let's take a look at this weakness that is built into this system so that we don't have to pay 139.5%. And I'm going to show you some of the clients that I have that take that 139.5%, that take that 51%, that take that 71%, or wherever your mortgage happens to be, and turn it into 1% or less by the time we've counted up how much interest they actually pay. So here is the weakness in the system. Every principal balance you see here, has an interest cost attached to it. So the very first one was $500,000. So we're going to take that 7%. Okay. I'm going to put that calculator on the screen. We take 0.07, divide it by 12. This is what the bank does. They take 1/12 of the interest payment, and then multiply it by the unpaid balance. So if we take that and multiply it by 500,000, Okay. It comes to $29,1667. That's exactly what your interest payment is, or the discounted portion is exactly on your amortization schedule here. Now, once you apply the $400, the $409.84 that's left over to the loan, now you're left with $499,590.16. So what do? They do the same thing all over again. They take 0.07 divided by 12, take that, and now they're going to multiply it by 499,590.16. So they get to multiply it by 499,509.16 equals 2913.80. Okay. What did I do wrong? I did something wrong. Hold on. Oh, I did something wrong. Okay. So we got 0.07 divided by 12. Take this number and multiply it by 499,590.16 equals, all right, 2914.28. There it is, 2914.28. That's what they keep doing. Now, what's happening is they take the unpaid balance and multiply it by the 1/12 of the interest rate, which means every single month you do this, you get a brand new mortgage. Every single month you make a payment, you get a brand new mortgage. Jonathan Bing in the house, everybody. All right. Everybody, listen, send a message to Jonathan and thank him for providing this space. Jonathan, how are you doing this morning, sir?
On top of the world, man. On top of the world.
You,
How you doing today?
listen, man, you're always on top of the world. I wish, listen, if I had your hand, I'd throw mine in.
I love it, Don. Love it. At least if I can start pinging some people here for you, brother.
All right, brother. I appreciate it, man. I appreciate it. So listen, folks, Jonathan Bing is a mortgage broker, And what we're trying to do here is tell you that I love mortgage brokers. I love the bank. I love what they can do for me. You know what else I love? I love the fact that I can borrow money now at a discount. I don't have to give it. I don't have to do what they're doing to me. I don't have to take it. I could do something different. So every single month, ladies and gentlemen, every single month, they get to charge you 1/12 of the interest rate and turns it into 360 separate mortgages. Okay. So if you want to know more about how not to do this, I need you to hang around. We're going to take a little break. I need you to hang around, and then I'm going to share with you how not to give them all of this money. All right? Are you ready? So let's take a little break. I'll get some water, and I need you to either watch or listen to our little commercial here. Here we go. How many want to know how to pay off all of your debt in an average of 7 to 9 years? You can do all of this without refinancing, without change to your budget, without sacrificing lifestyle.
Me and my husband do the P.I.L.L method, and last year we were able to pay down $33,000 on our mortgage without feeling like we were poor. We still did tons of entertaining things and enjoyed our family.
You don't have to eat beans and rice every day. You don't have to cut up your credit cards. You don't have to drive a 30-year-old car. You don't have to sell pizzas at night to pay off your mortgage. All you need to do is pay the bank less interest. That's what we're talking about today. Here is what P.I.L.L method stands for: prepayment of principal, isolation of principal amounts, leverage, and liquidity. understand it, you have a way of getting out of debt more efficiently. The interest rate you're quoted is not the interest rate you pay. You think you're buying a $500,000 home. The true cost of that home is what? $758,000. Total interest paid as a percentage of principal, 51.777%. That's what's going on with this loan. The ability to read and defeat an amortization schedule is not taught at any level of financial education. I need you to understand the power of a penny. You will not hear what I'm talking about from Dave Ramsey. Do you know why? Because I own the copyright. I literally wrote the book.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.
All right, we're back, ladies and gentlemen. We're back. So I promised you that you would be able to see the weakness in this system so that the banks wouldn't be able to charge you so many times. So those who are investing in your mortgage would not be able to discount your payment so many times, so that you can be done in about 78 to 90 payments instead of 360 payments. How do you do it? You give the bank their money when they're not expecting it. One more time. Okay, Jonathan, did you know your mic is open? Okay. You give the bank their money when they're not expecting it. Hold on for just a second, ladies and gentlemen. I want to see if I can mute Mr. Bing here. All right. Okay. I need to. Hey, Jonathan, can you mute your mic, please? All right. Hold on. All right. I can't.
He might be bringing chatter over, Don.
Okay, but he does it in a different way. He doesn't leave his mic open to do it.
You can't mute him. Just touch his profile.
Yeah, I tried that.
Hit the three dots in the right hand corner.
All right, hold on. Okay, you're right.
Okay.
There we go. You're right. Okay. All right. Okay, folks. Now let's take a look at this thing. Let's take a look at it and see how we can use small amounts of money to kill tremendous amounts of discounted interest. So let's just say we made a payment in January. The bank discounted our payment. All right. We weren't happy about it, but they did. Now I'm looking at, I just made January's payment and I'm looking at February's payment. The way this thing breaks down is if the bank sees this number, the principal payment on line one, then they will charge interest on that number. They will charge interest on that number. Okay. But if they don't see this number, if they see a different number, then they have to charge interest differently. So if I'm looking at, now this is not how my program works. I'm just using this as an example. I can see that my next principal payment is $412.23. Now, based on what you know to be true, February's principal payment is $412.23. But do I have to wait till February to give the bank the $412.23? Do I have to wait? Okay. Yes or no? Put it in the chat.
No.
You don't have to wait. You do not have to wait. So if you have it, you can give it to the bank early before the next payment. You give it to them when you want to instead of when they're expecting it. If you give it to them when you want to, every single penny of this money goes to principal, and you're paid down to line two with just $412.23. So what happens? How does this work? Line 2 has just been eliminated from your amortization schedule. That payment is now gone, and you did it with only $412.23. Can you imagine? Can you imagine how that made the investor feel? That you paid your loan down by 412.23, but they did not get this interest on line 2, the 29.14.28. You just reduced their overall interest gain by nearly $3,000 just by giving the bank $412.23 early. Are you all seeing that? Does this make sense to you? Do you want to keep giving the bank this kind of money? Do you want to save more? Well, listen, what if you found this out today? Okay. Otis James saw it. He recommended my book. Anthony Glenn saw it. He said he was going to bring his portfolio to me. You heard him. All right. And because they've never seen anything like this before. Jonathan Bing actually saw it and invited me to come in here on Wednesdays and share it with you. So what if we did this? Paid the mortgage on line 1, just exactly as the bank wanted. But what if we took a look at the next 3 principal payments? 412, 414, 417, a little over $1,200. Now, I'm not saying you have to do this. I'm just saying, what if? What if you had a little over $1,200 and you took the next 3 principal payments and applied them to the loan in January? Do you realize you would be paid down to line 4 in 1 month? Your next mortgage payment will be on line 5 of the schedule in February, and you just eliminated line 2, 3, and 4, nearly $9,000 in interest you never have to pay because you gave the bank that money that they were going to get anyway. You gave it to them early. How about that? How does that sound to you, ladies and gentlemen? That the $9,000, let me put it to you this way. Let's say you were selling the house. You were selling this house as a seller finance deal. You're financing it for someone else, okay? And you are charging 7% interest. And every time they gave you $3,300, you got to discount it by $2,900. So only this much paid down the house, and you're selling it. You would love this. You would absolutely love it. But you would think differently about it if they gave you the $412 early and you missed out on $2,900. If they gave you $1,200 early and you missed out on nearly $9,000 in interest, you'll never get to collect because they found out how all of this works. Okay. All right. Hold on, folks. Let me give them, they'll give them my link to the YouTube channel. All right. Let me pull up my notes. All right. There we go. Copy the link and give it to them. There we are. Okay. All right. So we're back. So what we're doing here, ladies and gentlemen, is showing you that all of this is a suggestion. We never learned how to do it. So if you want to keep from paying 139% on a 7% mortgage, learn how to use what we use. If you have a mortgage today and you want to know the month, day, and year you can be debt free, Nora is on YouTube, okay, says here, all right, Nora, all right, she says, okay, just pay bi-weekly and you'll take 10 years off a 25-year mortgage and automatically save. You know, Nora, you can save a lot of money with a bi-weekly payment, okay? But we're talking about paying off a mortgage in 7 years. You're talking about paying off a 25-year loan in 15. Okay. So we never get a 25-year mortgage. We always get a 30, and we show people how to pay it off in 7 to 9 without using a biweekly payment system. So, Nora, if you want to know how to save 2/3 of that interest and eliminate all, thousands upon thousands of dollars in interest and pay off a mortgage, not just your mortgage, but your mortgage, student loans, credit cards, and car loans. If you want to pay all of that off in about 7 years, then you want to learn how to be more exact in saving interest. So, ladies and gentlemen, if you want to know more about this, go to ice10k.com. ice10k.com. Let me put it on the screen for you. ice10k.com. Okay, ice10k.com. All right. And scroll down underneath ET's picture. Scroll down underneath his picture and click on Get a Savings and Earnings Report. It's free. You can know the month, day, and year you could be debt-free on your mortgage without, you don't even have to make a biweekly payment. You're going to be paying once a month. So by making your regular mortgage payment and following our system on when to give the bank money when it will benefit you instead of when they want you to, using our system, we can get you out of debt in an average of 7 to 9 years. And you can get a savings and earnings report, which shows you exactly how much interest to save, exactly when to pay, and will tell you the month, day, and year you could be debt free on all of your debt. And that report will be free. So go to ice10k.com, get your savings and earnings report, put in your financial data, and our staff will get that information from you. We will give you a call, confirm all the information that you sent to us, and then produce your document. It's 2 pages, and you will see the month, day, and year you could be debt free and how much interest you can save. You do not have to give all of your money to the bank. So I'm looking for all of you to get your free savings report today. All right. So back here. Okay. Now I need you to take a look at cumulative principal and cumulative interest, everybody. Take a look at it. Cumulative principal and cumulative interest. That if these 2 columns add up all the principal payments in 1 year and all of the interest payments in 1 year. So while you're looking at that, let's put this back on the screen. We'll put our calculator back on the screen. And in 1 year, here's what the bank wants you to do. Make your monthly mortgage payment because it's a payment you can afford. But don't look at how much interest you're paying. Don't look at that. Just look at the affordable mortgage payment that you have. Okay? And we're going to take that $3,326.51 and multiply it by 12. That's 12 months worth. Do you realize if this is your mortgage, you've given the bank $39,918.12 in 1 year? $39,918.12. But how much of that money actually went to pay down the mortgage? Now, somebody was in here earlier that said, this is the cost of doing business. Oh my gosh. Giving the bank $39,000 in 1 year, almost $40,000 in 1 year. And how much of that money helps you, pays down your loan? Only $5,079 and a penny. That's it. How ridiculous is that? $5,000 out of 40 grand paid down the loan. The rest up in smoke. How many of you are tired of that? Why does it have to be 139.5%? Why weren't we taught this in school? So here's my question to you. If you already know that in 1 year, by looking at this chart, you could pay this loan down by $5,079 and a penny, do you have to pay it in 12 monthly installments? Do you have to give it to them at $400 a pop every single month? Do you have to give it to them that way? Or could you do this? If you just happen, if you're blessed enough, if you just happen to have, watch this, $5,000. So this is a $500,000 loan. If you just happen to have $5,079 in the bank, did you realize you could give them that money on line one, make your mortgage payment, and then give them the $5,000 out of your bank? Look and see what happens. So if we gave them this $5,079 on line one, they'd have to subtract it from what we owe. So let's subtract $5,079 and a penny. We get $494,920.99. That's exactly what we have here on line 12 of the amortization schedule, right there, ladies and gentlemen, right here. So if we could get paid down to there in 1 month, oh my gosh, I get excited every single time I do this. If we could give them that $5,000 in 1 month instead of over 12 months, you're paid down to here in 1 month. You skip all the interest payments between line 2 and line 12. They're gone. You never have to pay them. Your next mortgage payment is actually on line 13 of the schedule. This becomes February's new payment on line 13. If you start in January and you give the bank $5,000 on top of your payment, your next mortgage payment is on line 13. You wipe out a whole year of mortgage payments with $5,000, not $40,000. So how much interest do you actually pay to pay it down here? The bank or the investor that bought your mortgage would love for you to have given them $34,839.11. But if you give them that money early, guess what happens? They only get $2,900, $2,916.67. Do you know how upset that makes people who invest in mortgages? You know how upset that makes them when you give them that money early? You just cut them out of $31,949.52 in interest they will never receive. If you don't do anything else except make your monthly payments from now on, that's $31,000 or nearly $32,000 that they'll never receive. Can I show you what would happen if you did this? Now, some of us are blessed to have maybe a little bit more money. Can I show you? This is just an example. You don't have to do this. This is just an example. But what if you had $10,000 in the bank? What would happen if you paid this $10,000 all at one time, instead of giving them $70,000 to do this? In 24 months, if we take that payment and do it the bank's way, that payment of $33,326.51 times 24 equals $79,836.24. So in 2 years, you would have given the investor $79,836 if you just make your mortgage payment on time. 79,000, almost 80 grand you've given them over 2 years. But out of 80 grand, only $10,500 counts for you. Lord have mercy. I have to sit back on that. I do this all the time. But when I actually see the numbers, it takes something out of me. to give somebody $80,000 and only $10,500 counts for you. That just that just drains me. What about you? But what if you gave them the $10,500 up front? You take 24 payments off the board right away, and it saves you $66,000 in interest to pay your loan down to here. And it still only costs you the interest on line one, $2,916.67. $2,900 instead of $69,000. Folks, did you know your mortgage worked like that? We don't have to turn it into 139%. We can actually turn it into a lot less. Let me pull up some examples here so that you can see what our effective interest rate can be if we use the P.I.L.L method's opportunity cost calculator. Okay. Here are, we're gonna have that one there, and that's 4 examples. Let me pull up 4 examples here. Okay. And I'm going to show you when you can figure out how much interest you'll actually pay on a loan, except and then discount the interest that the bank wants or the investor wants, you can then figure out what your true interest rate will be. So on this loan, okay, this is a mortgage of 2.38%. We have $390,000. That's just in the mortgage. We have some other loans, and we have 5 credit cards, a total of $416,000. The bank wants $163,000 in interest on that. We show this client how to pay only $41,000 in interest instead of the $163,000, which means their effective interest rate is 0.64%. Not nearly 51, not over 51%, just 0.64%. That's the interest rate they would have to get from the bank to do this, which means we save them $122,000 in interest that they don't have to pay. And when we discounted what the bank is going to receive, $122,000, guess what? More money goes to principal, and they can pay this loan off in 7.6 years. Look at that. 7.6 years instead of 27 years when they came to us, paying $41,600 in interest instead of $163,000. You don't need more money to get out of debt because we use their current budget to do this. You don't need more money to get out of debt. You just need to pay less interest. Let's stop giving them $139,000. Let's take a look at another example. Okay, here's one. The mortgage was just $75,000 by the time they got to us. They had $21,000, almost $22,000 in loans, and only $377 on a credit card debt. That's all they had, $377. But the bank wanted them to pay on their $98,000. The bank wanted them to pay $40,000 in interest. With us, they're only going to pay $16,800 in interest, which means their effective interest rate is 1.08. You can't borrow money that cheaply anywhere. You can't. We saved them $23,000, which means they could be paid off in 8.3 years with their current budget instead of 27. What about this one? This one is somebody who is trying to use velocity banking and it got away from them. They have 12 credit cards and a total debt on credit cards of $200,000 on credit cards. They have a mortgage of $634,000. They have 3 other loans for $197,000 for a total debt of $1,033,000. The bank wants $692,000 interest on all of that debt, but we're going to get them out of debt for only $179,000, which means they can pay off that loan, not in 36 years, but they can be done in 9. Their effective interest rate, 1.1. You see, what you need to know, folks, what you need to know is what's going on behind the scenes and why this whole system exists in the first place. It exists to make money, but you don't have to play the game their way. Can I get more people on the stage? Let's talk about this. How many are tired of playing the game the bank's way and they want to play it a different way? All of you who are watching online, put your questions or comments in the chat, and I'll be glad to answer your questions. Okay? People I don't know, people like to hear this, but they don't want to talk about it. Let's talk about it today. Okay? Are you thinking about getting a mortgage? Do you have a mortgage right now? Do you have car loans right now? Do you have credit cards? Have you looked at the interest lately and you say, you know what? I don't want to do this anymore. I want to do it a little better. You see, not only do you pay a lot of interest that you don't need to pay, you need to think about this. If you pay all that extra interest to the bank, you can't also invest that money. So the really big problem is this. The interest that you could have made that you didn't make should be considered a loss. If you give it to the bank to invest, you can't invest it. What if you can cut your interest cost by 75% to acquire the same asset? You can take the money that you would have spent on the interest that you actually signed a mortgage to pay, take that money and invest it in your family. And we have shown people who make regular incomes, teachers, police officers, people who work in offices, nurses, okay? Whatever your background is, okay? You're not making multiple millions, but when you take the interest money and that you didn't give to the bank and invest it in your family, for a lot of our clients, they're turning it into over $1 million when they invest it correctly. And that's at a 1% return on the money. Now, generally, you can get more than 1%. But when we do an analysis, we show you what that money could make for you if you don't give it to the bank at a 1% return on your money. So if it turns into $1 million, even at 1%, what would it turn into at 6% or 7% or 9%? You are in better control of your money when you understand how the game is played. We have been expected to play this game and nobody told us the rules. Nobody told us the rules. We exist so that you can know the rules today. So if you want to know more about this, go to ice10k.com, ice10k.com, okay? And get a savings and earnings report, okay? And so what we're going to do now, is we're going to come back in just a minute, but I need you to hear this from Dr. Eric Thomas, all right, who actually paid off his mortgage using the P.I.L.L method. Here we go.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, My boy was like, you ain't got to do that. You can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
Listen, folks, go to ice10k.com, click on get a savings and earnings report, and get a free one for yourself. And then you can know the month, day, and year you could be debt free and how much interest you could save. And just maybe, you would like for us to help you to achieve your financial goals of paying off your mortgage and investing in your family's future. Stop giving away that money to the bank. I'm just saying. Listen, learn how to borrow money at a discount. All right. 75% off, 80% off. You know, I'm not saying don't borrow money. I'm saying learn how to do it correctly. Why don't I have more people on the stage here in Clubhouse asking me questions or talking about, listen, if you're thinking about refinancing, if you're thinking about getting a mortgage, if you think you can't get a mortgage, if you're thinking, I don't want to get a mortgage because I don't want to pay all of that interest, find out what you can do more efficiently. You see, we were never supposed to pay all of that interest. Never. But nobody told us we didn't have to pay all that interest until now. And that's what we have here at the P.I.L.L Method. This is what we've dedicated our lives to do, making sure you know the truth about how all of this works. You do not have to keep giving that money to the bank. Look, can we go over that again? At 3%, 51% goes to the mortgage, goes to the investor. At 4%, 70, get rid of this one. 4%, 71%. At 5%, now we're talking 93%. At 6%, 115.838%. At 7%, the title of the show, 139.5%. You don't have to do that. Let me check. Go ahead. Yes.
Hi, I just want you to know I had to sneak into the restroom at work to talk to you.
Oh, come on now.
But listen, please know that I hear everything you're saying. I have been waiting to buy a home because of interest rates, and the way you have described this program and how to do this, I really feel like I can do it now.
Yes.
I just can't talk because I'm at work.
Okay.
So, but I need your help with the credit cards, with all of that.
Well, listen, you give us a call. I'm going to put our business number in the chat. You call my number today at 256. Okay. 886 1867. Okay. And we're going to
wait, one second. Okay. 256 886
1867. I put it in the chat.
867. Okay.
Okay. 1867.
Yes, sir.
So call and tell them you want to talk to me. And
Okay.
then I'll give you all the steps you need to see how about getting where you need to go financially. And I'm going to spend just a couple of minutes on 7% interest rates and why they're better than 5.5% interest rates. So you don't have to worry about the interest rate.
Wonderful. That's interesting. Thank you so much. And I'm here. I'm listening.
Listen, I thank you for sneaking into the bathroom, Paula. Come on now.
Okay.
Listen, Paula. I love it, Paula.
That's right. It's up, down in many ways in my life. It's up.
Okay. Where are you calling us from? What city?
I'm calling from Dearborn. I live in Detroit, Michigan.
Okay, you know I'm originally from Battle Creek, Michigan.
Are you?
Yes, I grew up there.
Okay. Okay, wonderful, wonderful. So you know where I am.
Yes, I do know where you are. Been to Detroit many times, and for some stuff I shouldn't have been doing, but I was there.
That's okay. That's okay.
But anyway,
Thank you so much, Don. I'm gonna get back to work, but I am here listening.
Okay,
You turn
Paul.
it off.
Thank you for that. So now, since Paula wants to now listen, folks, if you thought you couldn't do it, now you can. And I'm going to show you why a 7% mortgage works better than a 5% mortgage if you can afford the payment, because that's where interest rates are right now. And if you even talk to Jonathan, he will tell you that there are people out there that are waiting for the interest rates to go down. Okay. And I need to hear from you all. Every year on average, houses get more expensive or less expensive? What do you think, everybody? More expensive or less expensive? Okay. I see you, Judah Princess. Judah Princess. Are you there? Okay. Looks like they're on the phone, but I'm not sure. Okay. More expensive or less expensive? Put it in the chat if you don't want to come talk to me, but I wish you would come to the stage and talk to me. All right. Every year you wait, your house gets more expensive. Stop waiting for the interest rates to come down. Stop waiting. I see you, Paula. Okay. Stop waiting for the interest rates to come down. Let me show you what happens when you understand what 139.5%, when you don't have to pay it, because now you know the rules to the game. Okay. You know the rules to the game now. So that we're not going to give them 139.5%. We're going to show you how to borrow that money at closer to 1 or 2% instead, not 139.5. Okay. So remember this. If you want to borrow money correctly, control the principal payment and you control the loan. Stop trying to control the interest rate. Stop trying to buy down the interest rate. Control the principal payment and you control the loan. You see, the way that they built this thing, they teach us how to look at it backwards. Okay. So Shoshana says, I'm still a bit confused. Okay. My mortgage payment is due on the 1st of the month. Then they don't let you make another payment until the 15th. Okay, you need to call me. Okay, I'll show you how it's done. Okay, because if you're trying to make a bi-weekly payment, don't do that. Okay, there is, let me bring something up, all right, that is in your mortgage papers. Okay, since you brought that up, Shoshana, thank you for the question. I love it when people ask questions. So we're going to bring this up. All right. And I'm going to find this here. And this is in your mortgage papers. All right. And here we are. I need you to read this with me today, ladies and gentlemen. It is called the borrower's right to prepay. The borrower's right to prepay. It's a right that you have. You don't have to ask for permission. It's written right in your documents. Okay. And it says something like this: I have the right to make payments of principal at any time before they are due. This is what it says in your papers. Now, when you call the bank, when you call the mortgage company, guess who is the least informed about how a mortgage actually works? The people who answer the phone. Don't trust it. Don't trust what they're saying. Get with an expert that understands this, because this is what your mortgage papers say. See, when you know what your papers say, okay, no one can pee on your head and tell you it's raining, because you know what your papers say. You can go in and says, listen, here's what my papers say. I have the right to make payments of principal at any time before they are due. A payment of principal only is known as a prepayment. You can do prepayments. You can. Okay, watch this. When I make a prepayment, this is the second paragraph. When I make a prepayment, I will tell the note holder in writing that I am doing so. They have so many ways to tell them in writing. You don't have to send a note. You can go on their website. And if they have it set up, and most of them do, that there's a line that says principal payment only, or principal payment, or money in addition to your mortgage payment. I don't care how they write it. If you put even $1 on that line, that dollar will go to principal. And if you're working with us, I can tell you how much interest that dollar can save you. All right? We're going to break this thing down so that you can see how dollars can work for you. All right? Now, we're going to continue on and see what it says, okay? So, I may make a full prepayment. Now, what does that mean? You can make a full prepayment. What does that mean, everybody? That means you can pay the mortgage off if you have the money. You can make a full prepayment, or you can make partial prepayments. You can give them any amount of money before the mortgage is due, before the due date. They have to accept it and apply it to mortgage principal. They have to, if you follow the rules. This says this in your papers. I don't care if your payment is only a penny. I show an example where 1 penny paid to principal can save you about 7 cents. Don't you just love it? Okay. So I may make a full prepayment or partial prepayments without paying any prepayment charge. So in America, there are no penalties for prepaying your residential mortgage. And even if it was, I wouldn't care. Do you know why I wouldn't care? Because if I prepay, I know how much interest I'm saving. And then we'd have to calculate what my penalty would be. And I've never seen where the penalty was even close to what the interest we were saving. I did an example for a couple in Canada where they were saving $100,000 in interest for prepaying, and their prepayment penalty was $1,200 to save $100,000. So folks, if somebody was threatening you with $1,200, would that keep you from saving $100,000 in interest? If the threat was, yeah, you do that, and we're going to charge you $1,200, you would laugh in their face. Why? Because you know the rules. When you know the rules, you can go to your mortgage company, you can go to your bank in a position of strength because you know the rules. You know how the game is played. Come on now. Let's read the third. We're going to read this third one together. Okay, Mimi, I see you. Let's bring her up. Okay. Invite to speak. Oh, come on, Mimi. Raise your hand. Come on up. You don't have to speak. You can just come on up. Maybe you were just raising your hand because you thought that was good information. Okay, that's all right. But I'm glad you're here. I am glad you are here. Okay. All right. That's okay. That's okay. But listen, I need you all to know to go on YouTube and watch my videos. If you like the shorter videos, we have videos on Instagram. We have videos on TikTok. So we have people ask questions, we answer the question, and we show the numbers on the screen. Okay. Now let's read the third paragraph on this. And this is the most powerful paragraph in your mortgage papers. Okay. Oh, don't worry about it, Mimi. I wish you would come on up to the stage. You don't have to say anything. I wish you come up to the stage and just sit. Okay. Because we like your profile picture. Come on up. You don't have to say a word. I promise. Okay. So raise your hand. We'll bring you up because you sit on the stage. More people will come in. Listen to this third paragraph and read it with me. The note holder will use all of my prepayments. How much are your prepayments? All of my prepayments to reduce the amount of principal that I owe under this note. When your principal is reduced, ladies and gentlemen, it is impossible for them to charge you interest. How would you like to make it so that it's impossible for the bank to charge you interest? You are in control. You. Listen, in a minute, I'm going to show you how you can figure out how much interest you can save with just $1. It's crazy. Okay. All right. So Paula, let me see what Paula's saying. Paula, what are you saying? Sometimes we just don't know what to ask until we digest this awesome information. Just keep watching my videos over and over again. And do you know that each and every one of my clients gets a coach assigned to them? They don't just get a program and say off into the sunset. Let me tell you a little bit of something about our program now that I'm here. Okay. On Clubhouse or anywhere else on the internet, people are selling courses, they're selling this, they're selling that, and people buy it. Okay. Let me tell you something. If you do business with us, we guarantee your results. What? We guarantee your results or your money back. I need everyone right now, when you get a chance, to Google P.I.L.L Method. Google us. Google P.I.L.L Method. Go to our Better Business Bureau. See how long we've been in business. See our A+ business rating. See that we haven't had one single complaint in 20 years. Not one complaint. Because people achieve the results that we promise, or they don't pay. Do you know we give people a lifetime, I will repeat it one more time, a lifetime guarantee? And when you pay off your first mortgage, you can replace it and pay off a. Look, we have people who are paying off their third and fourth mortgage on this program. They pay us once, that's it. And they use it over and over and over again for the rest of their lives. If the program ever stops working correctly and we can't fix it, they get their money back. I don't care if they've paid off 10 houses. It's in writing, ladies and gentlemen. It's in writing. No one you talk to, no one you hear talking on this app, nobody will guarantee the results or your money back. And we guarantee it for life. How about that? You get the results that we promise if you follow our program. If you're following the program, I will repeat that. If you're following the program, we will guarantee your results. If you're following the program, you don't get the results we're talking about, money back. And in 20 years, guess what has happened? Only one person has received a refund. And I'll tell you why. When we get information from our folks and say, okay, how much are your bills each month? And one of the bills is, how much are you spending on gasoline? Now, this family's finances were fairly tight to begin with, okay? And we based all of our information based on the fact that they pay about $200 a month for gasoline between two cars. Well, it's a car and a truck. When in fact, the husband was working out of town on a long-term project and spending $800. They were spending $800 a month in gasoline, which threw the numbers off completely. It was a total mistake. We did not know that until they had paid for the program and started using the program and putting the information in and correcting some of the information. That's when I found out that they were paying $800 a month, and it wasn't going to be for just 1 or 2 months. It was a long-term project. So I said, it looks like you pulled the trigger too quickly on our program. Let us give you a refund and then come back when you're not spending so much on gasoline and we can help you. The young lady said, no, we really want this program because we want to save this interest and get out of debt. Can we stay in a little bit longer just to see what happens? I said, I'll give you 30 days. Okay. After 30 days, it didn't get better because, I mean, math is math, ladies and gentlemen. Math is math. So it wasn't looking good for them. So they decided to go ahead and take the refund and come back at a later date. Do you know that lady gave us a 5-star review? Because we offered to give them the money back because they just weren't ready yet. So let's finish this up. The borrower's right to prepay. Okay, the borrower's right to prepay. It says here that the note holder will use all of my prepayments to reduce the amount of principal that I owe under this note. If I make a partial prepayment, there will be no changes in the due date or in the amount of my monthly payment. All this means is your mortgage payment is your mortgage payment. It doesn't change. It will be the same every single month. Now, I'm talking about the principal and interest. The principal and interest doesn't change. The only part that will change maybe be your escrow amount if your taxes and insurance changes. But the mortgage payment itself does not change, right? Because you make a partial payment. Only the number of payments can change, but the mortgage payment itself does not change. If you do this right, you can take what they want you to pay is a 360 payment course, 360 payments on the mortgage, and turn it into 78 instead. That's what we're talking about. And so whoever said that, I forgot who I was talking to. It's in your mortgage papers. No one can tell you you can't make a mortgage payment when you want to. It's in your papers. Give me a call at 256-886-1867. 256-886-1867. Call me today and I'll help you with that. Don't call me tomorrow. Call me today. Call me today and I'll help you with that. If you call me tomorrow to get on my calendar, it's $150 for an hour. Okay. Call me today and I'll answer that question for you for free. How, if you're making mortgage payments and they're not accepting it, I'll teach you and show you how you can get that done. Okay. There we go. All right. So let's get out of here. Let's get out of here. All right. Let's talk about now. I'm going to talk about, I want to talk about how these higher interest rates, even one that says that when I sign it, they want me to pay 139%. How I actually like the higher interest rates better than the lower ones. Write this down. Okay. I said it before, but I'll say it again. Control the interest, control the principal payment, and you control the loan. The second part of this is interest payments I skip don't matter. What you want to do, like anything else in the world, is pay as little as you can for what you're purchasing. When you go to the bank, you're purchasing money. What if you were in control of how much you paid for that? Not the interest rate, because that's locked in, but the total interest cost you can do something about. What if you could I could give you a 75% discount. Now, a lot of people hear me talking. A lot of people have thousands upon thousands have watched our videos. Okay. But let me say this. If I told you a surefire way of how to get gasoline at 50 cents a gallon, y'all be blowing my phone up. You would. But for some reason, I can tell you how to save 75% of all the mortgage that they're charging you. And compared to getting 50 cents per gallon gasoline, my goodness, we do get a lot of calls, but we would get more if we were telling people how to get gasoline for 50 cents a gallon. We would get more calls. I know we would. But you're going to pay far more interest than you'll ever pay in gasoline charges. So why not learn how to borrow money at a discount? Give me a call on that. We'll give you the savings report for free. Okay. So let's take a look at this 7% loan. And I'm going to compare it to the 5% loan. All right. 7%. And we're going to bring the 5% loan over here right next to it. There we go. And we're going to take a look at the beginning of it. All right. So first of all, if I could get a 5% loan instead of a 7% loan, look at the payment here, $33.26. Look at this 5% loan, $26.84. Right now, the 5% loan would be winning. Okay, because the payment is less. But what I'm looking at the payment. I'm not looking at how I can control interest cost. I'm going to put you in a position so that you can control interest cost better. $26.84 versus $33.26. Okay, so far 5% looks like it's winning. Let's scroll down to the summary. Okay, how much total interest does the bank want on a 5% mortgage at 30 years? $466,279. That's on the 5% loan. On the 7% loan, they want $697. Don, why are you saying the 5% loan, the 7% loan is better? Look at all the numbers. Right now, it looks like that 7% loan is killing me, only because we have not been taught how to read it. Once we've been taught how to read it, we can figure this out. 697, 139.5% versus 93%. Look at that. Total interest paid, $466,000 versus $697,000. But the key is in the payment itself. It's not in here. This is what's being sold to you. Some of you have an opportunity to buy a new built home, and the builder is offering to buy down your interest rate. If somebody offered me a lower interest rate, I would not take it. I wouldn't if I could afford the payment at the higher interest rate. If I could afford the payment, I'm taking the higher interest rate all day long. And let me show you why. Here's the lower interest rate. Let's take a look at this payment. Every single month, it's still getting discounted by $2,000 a month. Look at that. $2,000, $2,000, $2,000. Look at my principal payment. Only $600 goes to principal. Only $600 goes to principal. So in my very first payment, over $2,000 goes to interest, over $600 goes to principal. But on my number two payment, if I prepay $603, I eliminate this $2,080 payment. I can prepay $600 and wipe out line 2 at 5%. Now, the people who own the bank know that. The people who work in the bank don't know that. Okay? Let me show you what the 7% loan would do. And remember what I told you. 7%, you control the principal payment and you control the loan. The principal payment on the 5% loan is the second one is 603. Let's see the 7% loan. 409 and 412. Look at that. At the higher interest rates, the principal payment is smaller. But Don, the interest payment is bigger. Yes, but interest payments I skip don't matter. It only takes $400 of my money to eliminate $2,900 in interest. I knock out one payment with $400, not $600. If I add up all the principal payments for 1 year, if I add up all the principal payments for 1 year on the 5% loan, it comes to $7,376.84. Okay. If I prepay the $73.76, I could knock out a year's worth of mortgage payments and save myself over $20,000, almost $24,000 in interest. Okay. By prepaying $7,300. Can I show you what $7,300 would save you on a 7% loan? This is the 5% loan. If you prepay $7,300 on the 7% loan, look what it does. It knocks off 17 months. Look at that. Almost a year and a half. Almost half a year more. Why is that? Because the principal payment is smaller, which means the dollars that you have left over work harder for you at the higher interest rates. Did you all know that? Does this make sense to you? So Paula, I hope you're still listening. Oh my gosh. Listen, folks. Control the principal payment and you control the loan. You don't have to keep paying 139.5%. You don't. You don't have to pay 139.5%. You can get this thing down to where you're paying the interest. The amount of interest that you actually pay will be your effective interest rate will be around 1% or less. Okay. Do I have any questions about this whole idea of what's happening behind the scenes? How much money people are making because we're not taught. I don't care what you're using, what type of research you do. If you go to the library, if you use AI, I've used chat GPT, I've used Perplexity, I've used all sorts of search engines. The more you look for this information, it's not there. I did a whole study on this. There's not one school in America that's teaching what we're teaching here today. Not one. Why is that? Because our mortgage system is built on the back of selling the mortgage to investors. The whole mortgage system is built on that. The mortgage has to look good to investors. So if more people knew that on a 7% loan, on a $500,000 mortgage, $512 prepaid, the investor would lose $2,900. If more people knew that, they'd have to change the whole mortgage system, wouldn't they? Because nobody's going to invest in mortgages. Listen, if I'm investing in this mortgage, I'm looking at getting a major part of this $697,000. Okay? I'm looking at that. Okay? I'm not willing to lose 75% of that. I don't want to lose 75% of that. Let me do this. I've shown this before, but somebody may be new here. Okay? So we're going to put in mortgage backed securities. Okay, mortgage-backed securities. So a mortgage-backed security, MBS, is an investment that gives the buyer a share of the cash flow from a pool of mortgages. Mortgage-backed securities are a type of asset-backed security similar to a bond. So I get a mortgage-backed security, right? We bundle up the mortgages. And, because most people don't know the benefit of prepayment, these mortgage-backed securities make a lot of money. Okay. Now, those who manage the fund, guess what they study? Watch this. Mortgage-backed securities and look at this, prepayment risk. What is prepayment risk? Okay, definition. Let's click on that. Okay, prepayment risk. Risk is the risk involved with premature return of principal on a fixed income security. When debtors return part of the principal early, they do not have to make interest payments on that part of the principal. What? Fernando, what's going on, man? Talk to me. How are you doing this morning? He's at work. Okay. But thanks for coming to the stage, my brother. I keep forgetting that. But let's read this again. The one thing that the people who manage these funds, the mortgage-backed securities, they're more afraid of this than they are of default on the loans. They're more afraid of prepayment than they are of default. Let's read the rest of this. What is prepayment risk? When debtors return part of the principal early, they do not have to make interest payments on that part of the principal. That means investors in associated fixed income securities will not receive interest paid on the principal. The prepayment risk is higher for fixed income securities such as callable bonds and mortgage-backed securities. Bonds with prepayment risk often have prepayment penalties. And the prepayment penalty is just to keep you from paying the loan off early or refinancing out of the loan early because of the prepayment penalty. Guess what people don't do if they should have a prepayment penalty? Guess what they don't do? They don't do the math. They don't do the math. So, ladies and gentlemen, if you want to know more about how all of this works, go to ice10k.com. Get our program, our opportunity cost calculator, and our coaching program. All of it is guaranteed to work, or you don't pay. Go to ice10k.com, scroll down underneath ET's picture, and click on Get a Savings and Earnings Report. Start learning how to understand how loans work. Start learning how you can borrow more, pay less money, so you can have more for less. Now, if I was offering you a handful of coupons for $1 off on everything that you bought at the grocery store today, everything that you bought at the grocery store, I'm going to give you a handful of coupons for every single thing you buy. I'm going to give you a coupon for $1 off. Do you know I probably would get more phone calls for that than telling you how much interest you're going to save, and I'll tell you for free. Do you know why that is? It's because we're looking at that long term. Something that's long term has less effect on us than something I could do today. Well, let me put it in terms that you can understand today. We're losing money daily. If you are paying interest, you're losing money daily. Let me put one of these up here. This is a savings report. Okay. This is a savings report. Here's some of the math that we do. Okay. For the folks, I need you to read this with me. This month, you'll pay over $4,400 in interest alone. That's 44% of your monthly payment gone or lost. I need to change that word to lost. This month, I need to listen to this. You will pay over $4,400 in interest alone. On average, over the next 36 years, your bank's plan will cost you more than $1,600 a month in interest if you stretch it out. But this month, so the longer you wait, this month, these folks are going to pay $4,400 in interest every month they wait at this point. Let me see. Okay. Let me take a look at this one. Okay. This is 108. This has only 262,000. Okay. This month you'll pay over $2,500 in interest alone. Okay. This one is only costing them $2,500. So it's not as much as 4,000. So is that going to make it any better? They're going to lose $2,500 in interest that they don't need to lose. Okay. Well, let's take a look at this one. Okay. Oh, that's the same one. Okay. Where they're going to lose $4,400. Let's take a look at this one. Okay. This is only $75,000 mortgage, $21,000 in loans, and only $377 on a credit card. Look at this one. This month, you'll pay over $390 in interest alone. So let me ask you something, folks. They're only losing $390. How much does it have to be before we realize losing any money is no good? One's losing $390. One's losing $4,400. We need to take a look at that. Whatever your loss is, we need to stop losing money in interest. It is not necessary. Every dollar lost is money you can invest for yourself. So when we're taking a look at, let me get this off the screen. When we're taking a look at saving money, okay, on the 7% mortgage, okay, well, on the 7% mortgage, if I prepay the 412.29, okay, the 412.23, I save $2,900 in interest. How much is that per dollar? So let's figure it out. How much am I saving per dollar? Okay, how much am I saving per dollar? So 2,900, 16.67. Okay, and I'm going to divide that. I'm going to divide that by what I prepaid, 412.23. Okay, divided by 412.23 equals $7.08. Can you imagine? So that tells me if I prepay $1, that saves me $7 in interest. Doggone it. Do you need a lot of money to save a lot of money in interest? No, you don't. $1 will save you $7. $2 saves you $14. $3 saves you $21 in interest you don't have to pay. How about making it? How about making it so that you can cut your interest costs with small amounts of money? And so you think about it differently, because what we're taught to do, ladies and gentlemen, is this. Here's what we're taught to do. Take your $7 and throw it at your $500,000 mortgage, and it doesn't hardly make a dent. But if you knew your $7 would save you, okay, you know that $7, okay, I'm sorry, that $1 would save you $7. So $7 would save you about $49 in interest. That $7 thrown at this loan wouldn't make hardly a dent in the principal balance. But what if you knew it could save you $49? Does that change the picture for you? What are you buying now on a regular basis that costs about $6 or $7 that you really don't need? Okay, $6 or $7 placed on the mortgage can save you quite a bit of money. You don't need a lot of money, folks. You can use your current budget and pay off the mortgage, pay off the credit cards, pay off the car loan, and you will still be able to go on vacation. You'll still be able to go out to dinner to eat. You'll still be able to go on a date night. You'll still be able to get your hair done and your mani-pedi. You'll still be able to do, you'll still be going on your shopping trips. You can still do all of that and live a great lifestyle, number one. Save additional money, number two, and pay off your debt in 7 to 9 years, number three. You can do all three simultaneously on this program. Why are you not going to ice10k.com and getting a savings and earnings report? Okay, so listen, I got another testimonial here. We got a testimonial to play for you today. So get ready, and I'll be back in just a few minutes after this to give you more valuable information.
It seems foreign at first. Like, you know the interest is there and you know it exists, but you just don't completely grasp how many tens of thousands of dollars that you're paying in interest when you don't have to.
No way. That was my reaction. Like 30-year mortgage and, 5 years, 6 years, no way.
So here we are, 6.5 years later, just finished a 30-year mortgage payoff, and some of those same friends are coming back to us that were skeptical at first, saying, now, what was this about again?
They're like, really? You're only 30 years old. You're supposed to be paying on that for a long, long time.
And going through business classes through college and understanding economics and managerial finance and how to operate small businesses, we understand we have debt, we have interest that goes along with that debt. But we just didn't understand how our amortization schedule was set up and how much interest we're actually spending. We didn't initially have the understanding because we haven't been taught this way before. Take a $5 cup of coffee. When you take that $5 and actually look at your debt and your amortization and how much you're spending in interest, really $5 could eliminate about $35 worth of interest. So the $5 cup of coffee is not a $5 cup of coffee. It's a $35 cup of coffee.
It took me a few tries to actually get it. He explained it to me maybe 2 or 3 times, and I thought, okay, nah, I don't know. I'll have to see this for myself.
Changing the word penalty to a cost benefit. The word penalty, it makes you feel like you've done something wrong. No one wants to pay a penalty or pay a fine for something. That's the question you have to ask yourself. How much is it actually costing me to pay down my debt? You're sitting there trying to look at it way too deeply, and you're looking for that catch. You say, okay, it sounds too good to be true. What am I missing? Finally clicked and the light bulb went off. We said, oh yeah, the catch is there is no catch. It really is that simple.
Every time you log in, you see that date of your complete debt payoff. That's my favorite part to see.
When you log into it and you're looking at that dashboard, you have different ways that will open up your eyes to motivating you even harder to pay off that debt. I know it's put us in a better position where we can provide a better future for our child and being able to enjoy some things in life and travel more.
I'm just super excited to be so young and to say we've paid off our mortgage and we can free up all this money to use for giving to others. There's all kinds of things that we can do. That's sort of been our financial goal at the beginning. We started in Honduras. The people there just took our hearts. We've been keeping in contact with them ever since then, which was maybe, 7 or 8 years ago.
They contacted us through Facebook and they said, we don't know what we're going to do, because the cancer treatments are just beyond reach for us. Because of the P.I.L.L method, when somebody who's devastated over a $600 cancer treatment that they can't afford, which we can't imagine it's even that low, we sit here and we say, well, yeah, here's money to get the cancer treatments done. We're not only putting our child in a better financial future, but we're also teaching her how to manage the money. And it's not that we have a magical program. You still have to have discipline, and it's the life concepts that we all need to pay attention to. Say hi.
You are so sweet.
So did you hear that, folks? This couple, barely out of college when I met them, in 6.5 years paid off their first mortgage. I say their first because now they're on their fourth. Getting ready to pay off the fourth mortgage. Okay. They paid off that mortgage and they did it in 6.5 years on this program. And their student loans, both of them had student loans and they were paid off the next year. So they were completely out of debt. And when they paid off that house you saw in the program, they put a renter in that house and bought another house and paid that one off, and then bought another house and paid that one off. Oh my God. And every time they do that, they put a renter in. How about that? Listen, folks, it's not hard to learn how to do this right. Borrow money the right way. Borrow money at a discount. Stop playing the game that the bank wants you to play so that investors can make a lot of money. Because what banks do, what mortgage companies do, they sell the mortgages to investors. That's how they make their money. So it is a big money game. And what makes it run is you and me on that hamster wheel of working 5 or 6 days a week, trading our time for dollars, and then taking our dollars and making a mortgage payment so that 80% of it can be discounted so somebody else can make some money. Well, I like borrowing the bank's money and paying them 75% less for it so I can get the same asset for 75% less. And I could take the money that they thought they were going to get and invest it in, maybe I can invest in real estate now. I can invest in a business now. I can put money in towards my future, my child's future. I can do certain things I couldn't do before because just living was costing me between 35 and 39% of my income. Just living, I was paying that on interest, and now I don't have to. So Andrea says, I'm also listening to work. I really want to learn this, she says. Well, Andrea, I really want to teach it. Okay. So I've given you, I put it in the chat. I've given you guys, I've given you my phone number. I've given my business phone number, which is 256-886-1867. So let me put in the comment section as well. Okay. 256-886-1867. Okay. Return there. All right. And I'm going to put it in the chat here. All right. 256-886-1867. Okay. There it is. Let me separate it out so it's easier to read. And ice10k.com. Okay. ICE, the number 10, the letter K.com. All right. And we're going to put something on the lower third here on our program here, and a banner. Okay. So our banner says, okay, for more info, that's our phone number. Oh, that's the wrong phone number. Sorry. All right. Okay. ice10k.com. ice10k.com. Get that, and we'll do this one. Start the process. It's free to start the process. To start learning more about this, you get coaching and you get technology combined. This is the most powerful debt reduction, wealth building, money management system on the planet that uses artificial intelligence. It's the only program in the world that combines artificial intelligence and finance for the average consumer. It is the only one in the world that does this. Nobody else comes close. Everybody else, in trying to pay off debt, focuses on two things: the interest rate and how much you owe. They don't focus on total interest cost and how to reduce it. They don't. So Carrie says, regarding your profile pic, I was working on that. Thank you. I got knocked away down and trampled on. So I love your words. Thank you, sir. You're so welcome, Carrie. So I'll bring you back up to the stage. Where are you? Okay. Carrie D, I don't see you. There you are. Let's bring you up. Invite you to speak. Well, you don't, and you don't have to say anything if you don't want to, but I'm going to ask anyway. Do you have a question or comment, Carrie? And I'll understand if you can't talk.
Oh, can you hear me? Good morning.
Good morning. How are you?
Good morning. Good morning. Well, I'm trying to climb back on up, like my other comment said. So I'll give you a question.
Yes, please do.
So it's kind of embarrassing, but here's the situation. Okay, I had a home, a beautiful one, and I was convinced to sell it, and then I was convinced to loan out all those hundreds of thousands that I sat on to my friends.
Mhm.
And anyway, long story short, in a nutshell, so it's been 9 years of, this is embarrassing, you guys. I'm just going to say it. Okay. It's been 9 years of renting a room, only not one room, moving and moving and moving due to crazy landlords and different situations. Okay.
Yes.
So, I mean, one of them didn't even own the house. We had to all move out in 2 weeks, all kinds of things. But anyway, I will jump in and I will buy my next house that I've been resisting because I've been dying to do it, but afraid of all that interest. Just because I've gone backwards, right? The old house from 9 years ago is obviously worth 1.5 million here in California now, right? So I can't buy that one, but I'm willing to buy something. I want to buy something. Will it work if I buy something and then jump into your program? And I'd love it if you could make an example of me. We could track my progress. We could track everything in front of everybody. I don't even care. I think it would be so cool and so much fun. And that would kind of like push me to just move forward and buy something, because it's the fear, right?
Right. Well, listen.
Because I gave away most of what I had. I've got a little left. I can get into a home.
I would love to do that with you. Listen,
That would be awesome.
listen, we could put that, make it a live example. You can do, small videos along the way from your phone. Oh my God, that would be great.
Mhm.
Carrie, wonderful. All right. So,
So how could that play out with that? So go ahead.
you're obviously you're working now.
I'm working. I'm a commission only person.
Okay, but that's okay. I love.
Well, sometimes it's okay.
Yeah, I like commission. All right. So can you get pre-qualified? Go
I
go
can.
go to a lender and get pre-qualified. All right. And can you stay in touch with me so I can help walk you through the process?
Absolutely.
Did you write my phone number down?
Of course I did.
Okay. So we need to let's walk you through the process. Let's get you pre-qualified. Let's get you with a realtor. Let's get you
Okay,
in.
I'm actually in the. It's all very ironic. I'm actually in the business. I've got a realtor.
Okay.
Her name is Carrie.
Okay, Carrie. All right. So listen, get yourself pre-qualified, Carrie. And let me tell you something. You'll sell more houses, okay, when in the back of your mind,
That's right.
you believe you made a good decision. You can help other people make a good decision as well. You'll sell
Well,
more.
absolutely. I'm trying to become an advocate for you because as I sit and I listen to you, and I think, how many lives can we save? The people who are just, buried in their mortgage payments and everything else, and that's what it comes down to for me. But I'm also trying to save myself in the process.
Okay. I love it. I love it. Carrie, let's work together.
All right.
Okay. So call the office. They're going to try to ask you a whole bunch of questions, but just leave the number and tell them that you want to speak to me and say, have Don call me back.
Okay, you got it.
All right. And we'll talk
right.
more. But do you have any other questions for me today?
Yeah, I just want to, I don't know. I'm excited to be the living example. I'm going to jump into it. I want everyone to learn from it,
Mm-hmm.
including myself. And then how many people can we help with this? I
Right.
mean, you're incredible. You're the only guy that I've really, yeah, there are a few more out there, but you're the guy that's, I don't know, you're incredible.
Well, thank you so much for that. Thank you for
Thank
saying
you.
that. So,
Thank you.
what are you hearing as far as people buying houses today? All right. Um, how's business? Let me ask that. How's business for you?
Well, that's kind of I, it's okay. I mean, it's okay. I'm jumping right back into it. I've got a couple clients who are about to sell their fourplex with me. They've done 2 deals with me previously,
Mm-hmm.
and they want me to do their third with them.
Sure.
And we'll be selling their fourplex that they had long before I ever knew them.
Mm-hmm.
But I it's precarious right now. People are waiting
Mm-hmm.
due to Trump, the new presidency, and
Yep.
everyone's anticipating different things with the interest rates, as you know, and
Mm.
it's a funny moment. But no matter what, there are always people who need to buy and sell,
Right.
right?
So let's help them. Let's help them to understand that buying process more. That they don't have to put a huge down payment on. They don't have to have that low interest rate. In fact, they'll probably, if they can afford the payment, they'll be better off at the higher interest rate. And they'll never refinance to get the lower one. They'll never take anything less than a 30-year mortgage and pay it off in 7 on average. Listen, there's so much we could tell them, and so much I can teach you how to use a simple amortization calculator that you can get online and teach some simple lessons to your clients in just a few minutes so that they can know that this is going to be a good decision for them. And then
Don,
go
I
ahead.
don't know if I'm the only one wondering, but the higher interest rate is the better deal
Yeah.
in this program because
Because because the ellipsis because that the principal payment is smaller. When you prepay a loan, you're prepaying with the principal payments.
Mhm.
Okay. At the higher interest rate, a small, let me put this back on the screen. Okay.
Wow. That's incredible.
Okay. Look, this is a 4%, this is 7% interest rate on a $500,000 loan. All right. And there we go. All right. And a 5% mortgage. Look at the small principal payment here. 400. Okay. It says somebody says, "What screen do we watch?" Go to YouTube. Take out your tablet, take out your other phone, go to your computer, and go to YouTube. The link is at the top of the page. All right, so you can see the numbers. Okay, so search for Pill Method if you're not using the link. Go to Pill Method, P-I-L-L method, and you'll see us on YouTube. But when you get there, subscribe and click that notification bell. All right, so look at this, 400. So if I make this first payment here, Carrie, all right, the second principal payment is only $412. If I prepay that, it kills this $2,900 in interest, and I drop down to line 3 for only $400. If I have a 5% mortgage instead of a 7, now I have to prepay $600 instead of $400 to do the same thing. How about that? Okay. Can I show you something very interesting?
Absolutely.
Okay. Are you in a position to see my numbers or no?
I am now seeing your numbers.
Okay, good. I am going to show you something. And since you've learned this, I want you to teach it to me. Are you ready to start teaching?
No.
Yeah, you are. Yeah, you are.
Because I was like fiddling around trying to get you up on a different screen, so I didn't
Okay.
actually.
All right. Well,
everybody else caught it, but I didn't catch it. Okay.
all right. Watch this. Watch this. So we're going to go to Brett Whistle here. Okay. And in the 70s, the median home price was $70,000 across the country. Okay. Interest rates got as high as 18% on a 30-year mortgage. How about that? Okay. Here is the payment, $1,054.96. Okay. And I need you to see what was going on here. If you don't know how to read an amortization schedule, you could get stuck here. On a $70,000 loan at 18%, the mortgage company or the bank wanted $309,785.60 just in, just in interest alone. Total prepaid was $379,000. Look at that.
Yeah.
Okay. That total interest paid as a percentage of principal, 442.5%. 442. Crazy numbers. Look at the payment. Let's see how the payment breaks down. Look at here when it stops moving. In the very first payment, how much goes to principal?
Payment principal for $1,050.
Nope.
No, I'm sorry. Hold on.
You got principal and you got interest.
I mean, principal's 4.96.
Yep, $4.96.
Oh, $4. Oh, wow.
Yeah.
Right.
Less than $5 and $1,000 to interest. So remember this. Control the principal payment and you control the loan. Interest payments I skip don't matter. Okay?
Right.
All right. So
Right.
on line number 2, which if we start in January, February's principal payment would be $5.03, wouldn't it?
Right.
What if I prepay that $5.03?
Okay. Prepay it.
I eliminate $1,049 in interest, and I kill line 2 on this amortization schedule.
Are you prepaying that in a payment by itself?
Yep, you can pay it by itself as long as you pay it before the next payment is due.
My Lord. What?
Yes.
What?
So if I made my regular mortgage payment in January and I gave the bank the next 3 principal payments, $5.03, $5.11, $5.19, a little over $15, I save over $3,000 in interest, and my next mortgage payment is on line 5.
Can you write one check for $15?
Yep, you could.
No.
Yes. You have to make your regular mortgage payment first, though, in the month. Then anything else would go to principal.
Oh, okay. In the same month. So every month you're paying some mortgage payment.
Right. Well, you're making a mortgage payment every single month. So right now the bank wants $360. If you give them money when they're not expecting it, you give them opportunity to charge you fewer times. So instead of 360 times, or 360 payments. Let's cut it down to 78 payments. Therefore, you pay a lot less interest because now you're giving them money whenever you want to, not waiting for the regular payment.
So if you add up all those $5 and they're going to go up, they're going to incrementally go up
Mhm.
for the next, how long, if you wanted to dump in a couple grand, would you say towards principal and that would knock out all those payments? Jeez.
Well, listen, well, you asked the question, right? Do you see where it says cumulative principal here?
Yes.
Cumulative principal, that adds up all the principal payments. Okay.
All right.
And you said a couple grand, but if I scroll down that far, it'll just make me tired. Let's do $1,000.
All right.
So we'll scroll down till we see $1,000 in this column. That means I
Okay.
made my regular mortgage payment and I gave them an extra 1,000. Okay.
All right.
So when I get to 1,000, we'll stop.
Wow. You're on 2 device. Yeah. Or I can hear you on.
Okay, here we go. And we're finally here, 94 payments later. We just knocked off
700.
94 payments
No.
and saved how much money in interest if we look over to the right?
Hold on. Let me see. What are those columns? Is it the 6 to
So
90?
well, I'm in the third column.
Yeah.
That's the 1,000. And now I'm going over to the right to the fourth column.
Nearly 100 grand.
Exactly.
Nearly 100 grand.
Because we don't know how an amortization schedule works. An extra $1,000 on a loan at 18%, we can kill a ton of interest with small payments.
My Lord.
Isn't that something?
So we actually want a higher interest rate.
Well, we don't want the highest interest rate. We definitely don't want the lowest. We want the right interest rate for us.
All right.
So depending on how much money you make, I have people who have, like you, they work on commission. I played a video just a few minutes ago. That was a guy who worked on commission. His wife's a teacher and he's a real estate agent. And they paid off their first mortgage in 6.5 years with an income that was, well, it wasn't static. It wasn't regular. Some months he did well and other months he didn't.
I'm very familiar with that and I'm laughing and crying all at once.
Okay. But what you can do, we can show you what you can do with what you have. So the idea is so we have an AI powered system that we plug all of our numbers into, and the program checks how much money you're making and how much money you're spending. Whenever it sees that you have money available in your checking account, you don't need for anything else because we track your entire budget. It tells you to put that amount left over in a savings account, no matter what it is. And then when it reaches a certain amount for you, it says take some of that money out of savings and apply it to the debt. Now, will you do that every month? No, you're only going to do that at certain times during the year, every 3 to 4 months or so. The programs that tell you, okay, let's get a spreadsheet. Let's put $100 in every single month, and this is when you're going to be out of debt. Well, what if you didn't make any money that month? What if the hot water heater blew up that month? Okay, telling somebody to give them a static amount of money and say, put this on your debt every month. Every time you don't, you get behind.
Right.
But what if there's a program that says, well, it's dynamic, it's breathing, it's living. So even if it's $1 this month or $5,000 this month, if it's an overage, it goes into your savings account and it waits there until it's time to put some money on principal on one of these loans. So you're putting it out of your savings account, not of your regular budget. What a novel idea.
Love to see one of these on a huge, not huge, but like on on a purchase price that sort of is today's market.
Really? Would you like to see that?
Yes.
Oh, okay. Ask and ye shall receive.
All right. I like this.
Okay.
Okay.
All right. Let's see here. 1, 2, 3. $6.5. Okay. It's not out of the realm of possibility. 1.7 million.
Okay.
Okay. Let's
You don't have to go that high.
okay. How high would you like to go?
All right. Let's do 650, like a $650,000 purchase.
Okay,
Or
600.
700. Let's go to 700.
We'll go to 700, just like you said.
All right. Okay.
Okay, 700,000. Okay,
All right.
6.5%, because we won't even go all the way to 7. How's that?
700K, and probably have to go to, okay, 6.5. All right.
All right, you want to do that, or you want to do 7?
Yeah.
Okay, so we'll do that. Here's the payment. 44, 24, 48. That's just the principal and interest. And here's how the payment breaks down. How much goes to principal and how much goes to interest on the first payment?
Okay. I feel like people can relate to this too.
Oh, yeah.
This amount, like, okay. Oh, there's your first principal payment,
Mm-hmm.
$632.
Right,
Your interest, 3,800.
right. And now
Yeah.
payment number 2, if you had it, you could prepay the 636.24, eliminate line 2, eliminate the $3,788 in interest, and your next mortgage payment for February would be on line 3. It's that simple.
And is it that simple where the mortgage company shows you that, or is it
Oh, no, they don't show you.
more, it's more obfuscated, like in the scheme of what you owe, is it clear cut
What's clear cut is this.
once you do it?
Any amount I put on principal, they have to subtract.
Mhm.
What is not clear is how much interest you just saved, because they never tell you.
Okay.
Okay.
Right. It's not as clear. It's only clear to us,
Yes.
but not to them.
Right. So
It's clear to us because of what you've made available to us.
right. And that's why most people don't. If they knew what a small amount of money could do for them. So everybody's thinking, I have to come up with a whole lot of money to throw at this thing to pay it off sooner. Whereas all they need to do is figure out how much money they have and how to optimize interest savings. So what is the least amount I can put on this mortgage? And I'll repeat that. What is the least amount I can put out on this mortgage out of the money I have in my savings account to maximize the amount of interest I'm saving per dollar? Okay, let me put it this way. If I was able to save $7 in interest for every dollar I put on principal, I don't want to save $5 in interest for every dollar I put on principal, do I?
No.
But if I don't have a way to measure, how would I know the difference?
Right.
That's what our system does. It makes sure that when it's time to put money on principal, every dollar you have works as hard as it possibly can. We don't want it to work less hard because we put the wrong amount on the wrong loan on the wrong day.
Right.
There's so many variables that when we prepay, the results are wildly different. Okay, so give you an example. I got a guy who wanted to pay off a car. All right, and he had a loan similar to this. Okay, so he has a car. Let me kill some of these.
Oh my God.
Okay, he has a car, and it's $40,000 car at the time. Okay, so it's $40,000. Okay, 40 grand. I believe the interest rate was right around 4%. He had it for 84 months. Okay. And I always will ask people to get the longest term available and then just pay it off sooner. That gives you more options. Okay. Don't get the shortest term, get the longest term.
So would that including like a 40-year for a mortgage?
If I could get it, I would love it.
Got it. Okay.
Okay. Now there are some people that that maybe have gotten their loan modified and they put them in a 40-year mortgage and now they feel sick. When they meet me, we show them how a 40-year mortgage actually works. I need you to remind me. I'll show you the difference between a 15-year, a 25-year, a 30-year, and a 40-year mortgage. You will be amazed when I show you that. You ready? Okay, so total interest on this loan, okay? Total interest would be $6,000, $5,927. Okay? So if he paid this car off, he had the money in the bank, he paid the car off, saved himself, how much interest would he save? $5,900, correct?
Okay.
Okay. And he felt good about the fact that he paid his car off.
Okay. I
Okay.
don't see the 59. Okay.
You see that?
In this moment.
All right. But
Oh,
here,
oh.
you see it? I got to highlight it. You see that?
Yeah, I thought that was the dollar sign. It's on a phone. It's small. Okay.
Okay.
5,900.
All right. Next time you meet with us, make sure you have your tablet or computer handy.
I have it handy, but if I go there, there'll be a delay.
Okay. There is
I
it.
won't answer you as quickly.
Oh, well, no, you use
It's on right
Clubhouse.
now.
Use Clubhouse for audio. You use your computer just for video. You turn the sound down.
Right.
Okay. So here's what we're going to do. I'm going to show you what he did and what he could have done. Okay. With his 40 grand. If he had put his 40 grand on his mortgage, okay. Let me see here. 40
All
grand.
right. Don't pay off the car. Pay off the mortgage.
Yeah, put that 40 grand on this mortgage, right? I'm trying to find that $700,000 mortgage we did for you. I think I got rid of it. Okay. This is a 500,000, okay, at 7%. So we put
Okay,
that.
let's do that.
Yeah, we
500.
put the 40 grand on. Look at this. Look at this.
Okay, let's see that because that'll.
Okay. I'll wait for it to catch up. I've got the 40 grand highlighted. Knock off 78 payments off the mortgage.
That is paying off how much?
Put $40,000 on this mortgage.
Oh, you put 40. Okay.
Okay.
You put 40 in. Right.
It knocks off 78 payments and saves over $200,000 in interest. And what he did with 40 grand was save like $6,000 in interest instead. But he felt good about paying off the car until he called me. And I showed him this. He became a client that day.
Amazing.
Okay? Because he'll never make that mistake again. Stop looking at interest rates, start looking at interest costs, and our program does all of the math. And because there's a coach available to you, if you should ever ask, why is the program asking me to do this? This goes against everything that I've ever been taught. We are required here at the P.I.L.L Method to show you the numbers as to why this works, just like this. Every one of our clients can go online with a coach on Zoom, and we show them the numbers. This is why we're doing what we're doing. So it's not a black box that people don't understand. We tell you, we show you the numbers. So anybody who's in this business, Dave Ramsey, Susie Orman, anybody who calls them a self-proclaimed financial guru, they should be willing to show you the numbers to back up their claims. Dave never shows you the numbers.
Right.
Neither does Susie.
Right.
They just say, these things work. And to a certain extent, they do. But they don't show you how well they work. They're not showing you how inefficient they are in canceling interest. We just feel good that we're doing something.
Right.
But it's not optimized. Okay?
Yeah.
Yeah. So for lunch, I want to make sure I get a full lunch. Okay? I don't want one cracker with a piece of cheese on it and call it lunch. Am I eating something? Yes. Am I eating enough? No, I am not. So if we're doing something, here's what we're taught. We're taught to anything that we can do to get out of debt is as good as any other thing we can do. This guy said, I'm going to take 40,000 of my hard-earned dollars. I'm going to use that 40,000 and I'm going to pay off my car and save $5,900 in interest I don't have to pay, when he had a mortgage that was staring him in the face, that was costing him over $2,000 a month interest. Didn't even think about putting it there because we're not taught to think about it that way. So what if you could teach your clients how to do that? Do you think you could sell more?
Absolutely.
Absolutely. All right. Any other questions? Oh, I was going to show you the difference between all those mortgages, right?
Right.
Okay. Now, you might think that something's wrong, but it's not. So let me do this. Okay. $500,000 loan. At 6, we're going to do the 6%. Okay.
All right.
All right. Good.
Yeah.
So I'm going to get rid of these. So $500, 6%. We're going to duplicate that. This is 30 years. And this one's going to be at 25 years. Okay.
Okay.
300 months. We're going to get rid of that payment. This is our, okay, that's 25 years. The next one will be 15 years. So we'll do 180 months here.
Okay.
Get rid of that. Okay. This is why, all right, I'm going to show you why I never get anything less than a 30-year loan. Okay. I don't care how much money I have. I don't want a 15-year mortgage ever. Ever. Give me a 30 or a 40. Oh, I was going to do one more. I'm going to do one more.
Manage it. 40.
Yes, let's do one more. Duplicate the tab and do 40. 360 and 80. Okay, 360, 82. Okay. 360 plus 120, that's 480 payments. Okay, 480. There we go. There's our 40-year mortgage. Okay, and we got that. All right, now get rid of these doggone. That's what I get for when I use something for free. You got to pay those, got to watch those ads. Okay, so here is my 360-month mortgage. Okay.
Okay.
And I'm scrolling down to my first interest payment. Okay, what do you see here as my first interest payment?
Okay, $497. Oh, sorry, $2,500.
Okay, now here is my 15-year mortgage. What is my first interest payment?
$2,500.
How about that? Here is my 300-month mortgage. That's 25 years.
Okay.
Okay, let's look at that one.
Okay, so we're noticing a pattern here. So they all start out the same.
They all start off the same. Here's my 40-year mortgage. All right.
Okay.
So 40 years, 480. I'm scrolling down. Look at my very first interest payment.
$2,500.
Yes. Okay. So if we take a look at this, the first year, all the interest payments, if we add them all up, is going to be about the same. But the only real difference is my principal payment. On the 40-year loan, look at my tiny principal payment.
Okay, so on the 40-year loan, we've got 251.
Yep.
7.
Right. For the year, it would be 3,000. So look at column 3, $3,097, correct?
309,710. Okay.
Okay. So if I prepay that, I knock off 1 year on a 40-year loan. Okay. All right. But if I go to, now I'm looking at my, this is my 300-month loan. Okay. My 25-year loan. Now look at my principal payment. Look at how much principal I have to prepay to knock off 1 year. But the interest is about the same.
Interest, and then the 8,900.
Mm-hmm. Look at that.
8,900.
I got to pay so much more.
Huh.
Okay. So we're going to take a look at which one is this one? This one is our 30-year loan. Okay. 30-year loan, 525, $6,000, knocks off 1 year. And we
6140.
yeah, and we still save about $29,000 in interest. And okay, so we've got, this is, let me put them in order. I want to put them in order.
Yeah.
Okay. This is 360. This one is 180. We'll move it down here. This one is 300. Okay. So we got 360, 300.
And what was the 15-year?
Okay. So let me get rid of, this so I don't get confused. And we're going to get rid of this one too. Okay. So this is, all right. This is a 40-year. This is the 15-year.
Okay, 15-year.
Mm-hmm. Okay. We'll put that first, 15. Then we'll do.
Now, I guess the interest rates would have varied because they would have been higher for.
Yeah, but I'm just doing all at the same interest rate, so you can see that what we really need to be looking at. Okay, 360. Okay, and 300. Okay, so we have 180. We've got 300. We got 360, and we got 480. Now, when we take a look at the total interest cost for the year, all right, on a 15 years, it's 29,423.
29,423. Okay, wow.
Mm-hmm. On the 300-month loan, which is 25 years, it's 29,757 for the first year, almost the same. Okay, so here is the 30-year loan, which is 29,832.99, and the 40-year loan, which is 29,900. There you go. So so if I'm going to get a loan, give me the 40-year loan. I've got $200 gets a little over $200 gets rid of one line, whereas on a 15-year loan, because since you are a real estate agent, right? You can figure out what the payment would be on a 15-year loan, right? Okay. So the payment would be $4,219.28. So if I knew what the payment would be, if I had a 30-year loan, what would prevent me from making the 4219 payment on a 30-year loan? What would prevent me from doing that if I could afford it?
Nothing.
Nothing. So why chain yourself to a 15-year mortgage? Just get a 30 and pay the 15-year payment if that's all you know to do.
Right.
Yeah, I would never let anybody get a 15-year mortgage.
Right. Options.
I would do whatever I could to talk them out of it. Okay. Always get Yep. Always get a 30.
Right.
All right. And if 40-year mortgages ever get popular and there's talk about it going to 40 years because the houses are getting so expensive, I would take a 40-year in a heartbeat, even if it was a slightly higher interest rate, in a heartbeat.
Yep.
Because I could murder that thing.
Right.
All right.
Amazing.
All right, folks. I've been here since 7 Central Time. That's 8 your time. It's now 11 Eastern. I've been here 3 hours. Unless I get some more questions, I'm out of here. But I want to thank you for being here today to learn about 139.5%. You don't have to pay that. We can get that down to about 1% if you're fortunate enough to understand how to get a free savings and earnings report. And how do you do that? You go to ice10k.com. Okay. You scroll down underneath ET's picture and click that link that says get a savings and earnings report. And this is what it says. Don't waste another dollar paying off the wrong debt. Get your free savings report now. Fill out this portion, which is your contact information, and then click yes, I want to save down at the bottom. It will let you into our financial form, put the data in that we're asking for, and once we confirm all that data, when we call you back, our staff will tell you what your results are. You will know the month, day, and year. We can email that to you if you want it, and we can also set you up with a consultation. The consultation is only $150. So I'll go over all of this with you in detail for $150. And guess what? Even the $150 is guaranteed. If you don't like what you hear, before the call is over, I'll send it back. All right. We just have the $150 so people won't put an appointment on my calendar and not show up. So if you don't like your information, yeah, I'll send it back. I don't need it. Okay. But all the years I've been doing this, I've only sent one back. Everybody else was satisfied. All right. So, Carrie, thank you very much for being here today and helping out. Do you have any other questions?
No, you're awesome. I'll be talking to you, and I'm sure everybody appreciated those examples. I'm sorry I missed your first few hours, but I'm glad I showed up.
All right. Well, listen, go to YouTube and you can watch a lot of our videos that we have up there already. Or if you like the shorter videos, go to Instagram and TikTok. All right.
All right.
All right, folks. Thank you so much today. I'm out of here. I am out of here. Unless let me check and see if I have any other questions. Andrea, I see what you have here. I have a question about what you just showed. When you pay the principal to save the interest, Andrea, what's your question? Okay. Did she leave? No, she's still here. Andrea, can you come to the stage or no? All right, I'll invite you up. But if you can't, type your question out. She's at work. All right, so yeah, tell me what your question is. I have a question about what you just showed. When would you prepay? Oh, listen, our program tells you exactly when to prepay, but if you're looking for a certain day, that doesn't exist. When you're optimizing something, it all depends on all the data before you get to the optimized day and the optimized amount. how much are you making and how much are you spending. So we only put money on the debt strategically throughout the year, on average every 2 to 4 months. So the program is always looking for the right amount of money that you have available, and then calculating when is the right day to pay that money to the right loan. So it will never be the same amount 2 times in a row, and it will hardly ever be the same day, because we're looking to optimize your result. The days when people can give you a heuristic, all right, or a rule of thumb, this is the day and this is the amount. Those days are gone, because having a computer, having AI to help you, we can optimize, meaning you can get the very most out of every dollar, squeeze every penny of interest out of every dollar that's possible, because we did all the math, over 3 million calculations in just a second, to give you the right answer. Okay, that's what we're doing. All right, let me see if I got any other questions.
Shoshana has a question in there.
What is, okay, Shoshana? What's Shoshana's question?
She says, I'm still a bit confused. My mortgage payment's due the 1st of the month. Then they don't let you make another payment until the 15th. Yeah. After the 15th, is that when you make the principal payment for the next month?
Well, we went over that. If you have a biweekly payment, then yeah, that's what they're looking for. Okay. But my clients, if they come to me, if they have a biweekly payment, we get rid of it. It's confusing, and it's not very effective. The most you can save is between 4.9 and 7 years with a biweekly payment, turning a 30-year mortgage into, at best, a 23-year mortgage at best. Our clients on average pay off their mortgage in 7 years. So we're saving them 23, and they're just paying once a month. So biweekly payments are gone. We don't use them at all. But you can make a mortgage payment, you can make a prepayment at any time before the next payment is due. Okay, even if it's on the last day of the month. Okay, but our program will tell you exactly when. There's no rule of thumb that will tell you when. Or like, so people call me up and say, well, what's that day, Don? Do I make it on the 17th? Do I make it on the 3rd? Do I make it on the 5th? I don't know. The program's algorithm figures that out for us, so you can save the most interest, period. Okay, there you go. All righty. Oh, and when I come back next week, I'll play a little bit of the video that shows how the program actually works, and then I'll give you guys the link to it. I'll make a note to show you that we have a video that shows you how our opportunity cost calculator works. I'll give you that. Okay. So
that is awesome.
Let me see here. Anything else? Okay. What if they say prepayments go to interest? Impossible. Prepayments cannot go to interest. Interest is charged on principal balance only. Okay. So once you pay the principal, the interest for that month, there's no more interest due that month. So all the money goes to principal. It can only go to principal. So if somebody says the money goes to interest, who answers the phone, they have absolutely no idea what they're talking about. Zero. So get educated on how your loans work, watch my videos, and then speak with confidence. That's not right. Let me speak to your manager. You don't know what you're talking about. Okay? Get them off the phone. Besides, here's the other thing. What you learn here today, I recommend that you do not try to call your bank and have them prove to you what I said is correct. Guess who doesn't know how a mortgage works? People who work in the mortgage industry. They're not taught. Guess who else doesn't know? Every real estate agent I've ever met is not taught how a mortgage works. So Carrie,
That's right.
how do your whole business depends on mortgages.
People, I will say, people do not call your bank. That will be a disaster. Just do the program quietly. Don't call attention to yourself.
Because those folks are not trained on how a mortgage works. Okay?
It's just going to create a lot of, it's not a good idea.
Not a good idea at all. All right. Well, I think I covered all the comments and questions. I'll look here online. Yep, that's it for today, folks. I'll see you next week. Okay? So, what we're going to do is, let me see if there's another video I can play for you. What we're going to do is we're going to hear from okay, we'll hear from Eric Thomas one more time. That's just about 50 seconds. Then I'll play our outro music. That'll be our outro music. That'll be it for today. Thank you so much for showing up, everybody. We'll see you next week.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.